So you're ready to start investing in Vanguard's Total Stock Market Index Fund, VTSAX. You go to Vanguard's website to start investing, but then you notice this here, also available as an ETF. Oh no, another decision to make. What the heck is an ETF and what do you do? How do you know if you're making the best decision? Hi, if you're new to the channel, my name is Tay from Financial Tortoise, a channel dedicated to helping the sandwich generation reach financial security. Also, if you'd like a free copy of my Sandwich Generation's Guide to Financial Security, 10 Steps to Securing Your Family's Financial Future, please go to my website at financialtortoise.com and download your copy today. I'll also have a link in the description below. When it comes to investing in the Total Stock Market Index Fund, one of the most common questions I get asked is, what is better? VTSAX or VTI. The two Vanguard's total stock market funds are some of the most popular investment funds in the world, and it is a question that plagues so many of us. So in this video, I want to break down these two funds. We'll review the differences between an ETF and an index fund, and then we'll delve further into comparing VTSAX and VTI, and I'll give you my take on when one might be better than the other based on your specific preference. And finally, I'll go over my personal favorite and rationale. Let's start out by getting a general understanding of ETF and index funds. ETFs, exchange-traded funds, or as its name implies, funds that trade like stocks on an exchange. When the stock market is open, they can be bought and sold continuously throughout the day. Because of its flexibility, they appeal to a wide range of investors and have really gained popularity in the last decades for both long-term investors and short-term traders. And ETFs come in all shapes and sizes. There are ETFs like VTI that follow the total stock market index, and there are ETFs that follow foreign markets, bonds, and commodities. Index funds, on the other hand, are passively managed mutual funds that track an index. Index like S&P 500, total stock market, and many other securities. Because they're passively managed, they often have lower costs compared to actively managed funds. Now, what are the key differences between an ETF and an index fund? Let me review 5 of them. First is the timing of share price. There's a fundamental difference between how an ETF and an index fund is traded in the market. ETFs, as I mentioned earlier, trade like ordinary stocks on an exchange. It can be bought and sold throughout the day for a specific price at that specific time. This means that the price of an ETF can fluctuate up and down throughout a single day when the market is open. Index funds, on the other hand, don't have this ability. Yes, you can put an order to purchase an index fund at 10 in the morning, but the price to which you will purchase that index fund won't be set until the close of the market that day. You could have put in an order looking at the price in the morning, but if the market moved drastically throughout the day, you might be surprised to find that the amount which you paid for that fund is different from what you saw when you submitted your buy order. For index funds, the fund company prices the fund, the net asset value, only once a day based on the value of the securities owned by the fund. In essence, you're buying ETFs in real time, while for an index fund, you don't know the actual price of that fund until later that evening, or even sometimes the following day. From this lens, ETFs are quite attractive to investors who want to trade throughout the day and know the exact price of their trade. A second difference between ETFs and an index fund is what is known as fractional shares. Or more specifically, if you can purchase the fund in fractional shares. It sounds fancy, but if you know basic algebra, you get the concept. It means just what it sounds like. When you have the ability to purchase a fund as fractional shares, you have the ability to buy a fraction of the share. You aren't locked into needing to buy the whole share. For example, let's say VTSAX is trading at $100 per share today. You might only have $50 to invest. So you can just buy a fraction of that $100 share, essentially half a share with that $50. Now, VTSAX, the index fund, allows you to purchase the fund as fractional shares. However, VTI, the ETF equivalent, does not. With VTSAX, it doesn't matter how much you have. You can invest that full amount into the fund regardless if the money you have is $1 or $1,000. VTI, on the other hand, because it does not allow fractional shares, you in essence might have money left over or not be able to afford the share that day. It's almost like needing exact change at the grocery store. One thing I do want to call out is that this is Vanguard specific. Other firms like Fidelity allow for fractional shares for its ETFs. We'll need to wait and see if the trend will be more widely implemented across all investment firms. But for now, if you're invested in Vanguard like me, just know that you can't make fractional share purchases with VTI. And this segues nicely into the third difference. Automatic investing. You can't make automatic investments or withdrawals into or out of ETFs. This makes sense given you can't do fractional share purchases of VTI. You will need exact change each time, so you'll need to manually make purchases. For index funds, on the other hand, you can set up automatic investments and withdrawals into and out of any Vanguard's mutual funds based on your preference. If you're an investor who likes the idea of setting it and forgetting it, index fund like VTSAX may feel attractive here. The fourth difference is their minimum investment requirements. In this category, ETF like VTI wins. Because they're traded like stocks, there is no minimum investments. You just need enough to purchase a single share. Index funds, on the other hand, have a minimum. In the case of VTSAX, $3,000. So for investors who don't have $3,000 to invest, VTI has a lower barrier to entry. Cost is the fifth difference. And this is where an ETF like VTI has another win. Though both VTI and VTSAX are essentially tracking the same index, VTI has an expense ratio of 0.03% versus VTSAX's 0.04%. I mean, 0.04% is pretty low compared to the industry, but 0.03% is pretty amazing. Now that we covered the 5 key differences between VTSAX and VTI, let me go over which one might be better for you based on your investing priorities. If you're the type that is worried about price and you want to have full control over the specific price of the share when you buy, VTI is likely your best choice. As mentioned earlier, ETFs allow you to buy shares at a specific price throughout the day. If the market is quite volatile in a single day, this could have an impact on your investments. With an index fund like VTSAX, you technically don't know the final price until the market has closed and the investment firm has calculated the final net asset value of that fund. Of course, you should realize that trying to time the market could be a dangerous endeavor. And if you're looking to buy and sell ETFs throughout the day, you would be considered more of a trader than an investor. As the old saying goes, it's not about timing the market, but time in the market. But again, if you're the type that likes full control over the price, VTI is your kind of investment. If you're the type that prefers automation and likes to take a set it and forget it approach, VTSAX is likely your best choice. As I mentioned earlier regarding fractional shares, index funds allow fractional shares while ETFs do not. This also means you can set up automated investments with index funds, while with ETFs you cannot. With ETFs like VTI, you have to buy a full share each time. Whenever you want to purchase VTI, you have to log into your account with exact change, and you purchase a share of VTI based on the price that is trading at that specific time. Personally, I love automation. James Clear, the author of Atomic Habits, hammers this idea of systems. He says the key to reaching our goals is about having a system, a process that leads us to that result. Most people, I believe, will produce better results with automatic investments. You aren't trying to time the market or rely on your will to make a trade that day. This is all happening behind the scenes, and I believe this will produce better results in the long run. So if you want to automate your investments as much as possible, VTSAX is your kind of investment. If you're worried about minimum investment requirements because you have a limited amount of money to invest, VTI is likely your best choice. As I mentioned earlier, VTSAX has a minimum requirement of $3,000, while VTI has no minimum requirement, just the cost of the share. If you're just getting started and don't have $3,000 to invest, go with VTI. You want to get into the market as soon as possible, so don't let the lack of minimum requirements be a barrier. At the time of this video, VTI is trading for approximately $240. Get your $240 and start investing right away. Alright, there's a lot that I just covered, so thank you for staying with me so far. Let me share with you what I personally invest in. My go-to equities investments is VTSAX. While some people prefer VTI over VTSAX because of the reasons I mentioned earlier in this video, share price, minimum, and expense ratio, though these are very important and valid reasons, I personally prefer VTSAX primarily because it saves me time. I like the idea of automating my buy order so that trade is executed regularly every month without me even realizing it, whether I'm working or on a vacation trip with my family. Compare that to having to find time on Monday while the market is open to put in a buy order, calculate how many shares I can buy based on the share price, watch it to make sure the order executes, and get annoyed by the fact that there are a few dollars left over that can't be invested. Yes, does VTI allow for a specific share price? Does it have a lower expense ratio? Does it allow me to get in with less than $3,000? Of course, but for me, I prefer to spend the extra time making more money to invest in the market and with my family. Thank you guys for watching. Please let me know in the comments below your preference between VTSAX and VTI. There is no wrong answer here, just an answer that best works for your situation. I'd love to hear if there are decision factors that I missed or ones that really resonated with you.